Hey everyone, we got some huge news for DraftKings stock investors that sent the stock price down more than 11% on the back of the news. So I'll discuss what the item was that sent the stock price crashing, and then I'll discuss what it means for DraftKings stock investors longer term. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the big news item. According to media reports, Illinois senators have approved the 2025 budget that would raise the state's sports betting tax. That would have the largest operators, which include DraftKings and FanDuel, paying a mid to high 30% effective tax rate. That's a tax rate over 34%, compared with the current rate of about 15%. So their tax rate will likely more than double in the state of Illinois, and this is supposed to become effective July 1st. So this is going to be a big hit to DraftKings because they're going to have to pay more tax on their revenues and profits from the state of Illinois, which is one of the larger states it operates in. Remember, DraftKings does not operate in the largest state, California, or arguably the largest state, California, because it failed to gain approval to operate in the state. DraftKings needs to gain approval from each state to operate within that state. And over the years, as I've been discussing DraftKings stock, I've highlighted that as the big risk with DraftKings stock. It's basically at the whim of governments in those jurisdictions whether or not to allow DraftKings to operate. It can do so in a couple of ways. Number one, it can do so by just not allowing them to operate at all, or it can do so by raising the effective tax rate so high that it just becomes unprofitable to operate within the state. So it's a big risk for DraftKings. It's actually a big risk for nearly every gaming company because gaming is a heavily regulated industry, and that's one of the bigger risks you take when you're investing in gambling or gaming stocks. Now, the flip side to that is the saying, the house always wins. Well, the odds are always in the casino's favor or the gaming operator's favor. And so the more bets that are placed, the more money it will make. And so that part of the business model is incredibly lucrative. However, in order to be able to offer that business, it needs to gain approval from states or legislatures, which may or may not allow it to operate, or it may allow it to operate under certain conditions and then change those conditions when it comes time for that contract renewal. And so you're always taking that chance with gambling companies. That's the case with DraftKings. Still, the company itself has done really well. The stock price, even after this 11% decline here, down to $36 per share as of this recording, since bottoming out in 2023 at around $10 per share, it had jumped all the way up over $40 per share since then. So it's had a nice run up, and that's been on the back of improving performance. DraftKings has had several great quarters, and in the most recent quarter, it increased revenue by 53% year over year and raised the 2024 revenue guidance. The performance was so strong to start the year. It's also expecting to generate $400 million in free cash flow in 2024, and it has $1.2 billion in cash on the balance sheet. So it had turned the corner, but in terms of cash flow from operations and free cash flow, and it's become a self-sustaining business, and it's reached sufficient scale to do that. You can see DraftKings' unique customers in the prior 12-month period has grown by the millions to reach 7.5 million in the most recent update for Q1 2024. That's up from less than 2 million in Q2 2020. So it's more than tripled in that time. And part of the reason that it's grown so significantly is because it's gained approval in more and more states to operate within those states. Now, it had success in some areas, and in other areas it did not find success. Like, for instance, when it tried to gain approval in California, through a voting initiative. Voters voted it down by a significant margin. It failed miserably to gain adoption in California, but in other states it has done relatively well. So you can understand why the stock price had increased by as much as it had increased in that time. So this news is not good news for DraftKings, but it's a reminder to DraftKings stock investors of the risk associated with DraftKings stock. It's at the whim of governments. It's at the whim of legislators making this decision whether or not to approve or disapprove, and then playing politics with the local brick and mortar casino operators who could be working closely with the local politicians and telling them, look at all these jobs that are at risk if you allow DraftKings to operate. They're taking away business from us, and those are jobs that are offered to people in this state. Do you really want to do that? And so that's always the risk here. Now, if some of you are old enough to remember what happened to the online poker industry, I certainly am. I was a former professional poker player, and I used to play those online poker platforms like Party Poker and Poker Stars and others. Those were widely popular in the early 2000s, 2000, 2001, 2002. And then there was legislation that made it almost incredibly well. It didn't make it illegal for online poker operators to have their websites and operate, but it made it so difficult that it just made them say, you know what, it doesn't make sense for us to operate. And so they pretty much shut down the entire online poker industry through legislation that was passed federally. And online poker still exists, but it's only a fraction, a small fraction of the size it was in the early 2000s before government regulation really shut down the industry. So there's always that risk, and especially with gambling and with DraftKings stock, you always have to be mindful of that risk that at any moment legislation can come down the pike and just say, all right, no more of this, and really just shut down the entire industry. So almost overnight, it can go from hero to zero. And that's just a risk that DraftKings stock investors have to understand. And if they're still willing to invest in the stock, they have to invest with that risk in mind, knowing that this could happen to the business. So DraftKings stock is now trading at a forward price to earnings of 24.85, which I have said repeatedly is a attractive valuation and attractive risk versus reward. I just highlighted all of the risks associated with DraftKings stock. There's also significant upside. And with this valuation, I still feel that the risk versus reward is worthwhile. So I will remind investors that I do still have DraftKings stock rated as a buy. I last updated that on May 3rd. I'll update it again today, reminding investors I still think DraftKings stock is a buy. This risk that was just highlighted today is not a new risk. It's one that I've been aware of for a long time, especially given my experience with online poker. And so I understand that DraftKings stock and DraftKings business is always going to be facing this risk. And so we just have to be mindful and keep it in mind and understand if we still want to buy or not buy this investment. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.